Welcome to CFRA Thematic Insights, where we explore the market trends and investment themes shaping tomorrow's opportunities. Hello, I'm Alexander Yokum, and I'll be your host today. Today I'm joined by Nathan Schmidt, who just published a compelling thematic report titled 2026, The Year Crypto Goes Institutional. Now, Nathan, I've heard this before. I recall in 2021, lots of individuals were talking about crypto and how it would go institutional. But then, of course, FTX collapsed and crypto fell 80%, with some altcoins falling even more. So why do you think this time is different?
Well, I think it's really interesting to look at right now. If you look at the whole cryptocurrency market cap, you're looking at about $3 trillion. That's even after a sell-off we've seen in Q4 from the all-time highs. When you look at just maybe the top 7, 8 tokens in the space, you have 2 stable coins in there that I think are really interesting and compelling. USDT from Tether, the largest stable coin out there, it's over 150 billion. And then US dollar coin from Circle is over 75 billion in market cap outstanding. Those are gaining a lot of attention institutionally right now, especially considering Circle's IPO last year. And then beyond that, you have 3 smart contract tokens. Ethereum, a lot of people are familiar with. It's been around for a while. Solana has gained some steam, and Binance. And so these are crypto assets that allow smart contracts to be enabled on their blockchains. They're kind of the plumbing, if you will, of the infrastructure of the crypto universe for a lot of different projects and things that are going on. This year, we have a really robust IPO pipeline. We've got 7, maybe 8 companies that are going to go public that have an aggregate value of over 80 billion at their last, fundraising round. They're kind of spanning a lot of different crypto industries. So it's not just an exchange, it's infrastructure. You have a company like Consensus, if you're familiar with MetaMask. You have custody-focused companies. You even have a hardware company in Ledger and kind of a gaming space in the distant area as well. In terms of just Coinbase specifically, that we'll talk a lot about, they've transformed a lot since 2021. Their subscription revenue back then was about 8% of the business. Trailing 12 months at the end of Q3, that's 36% of revenue is subscription service revenue. It's not just retail trading fee platform anymore. It's not as focused on just Bitcoin and Ethereum. There's a kind of larger ecosystem growing in the background there. So that's what I find really compelling about now versus 5 years ago.
Yeah, no, that makes sense. And one part I thought was interesting about your thesis is you did mention this Deribit acquisition. I was looking at the acquisition details, about a $3 billion company versus Coinbase, which is about a $60 billion company. So that's only about 5% the size. So why do you think that's important, given that it's only a small fraction of Coinbase?
I think the biggest takeaway when you look at Deribit and you look at Coinbase and the integration there together is something like 70%, 70+% of all crypto asset trading is derivatives. So it's a $62 trillion market last year that was growing 30% versus a $16 trillion market in terms of volume for spot trading. And it's an area that Coinbase hasn't had a large presence in. And so buying a company like Deribit really increased the number of tradable assets on their platform. It plugs them into what they call decentralized exchanges. So think crypto to crypto trading on different platforms within, this is maybe a little confusing, Coinbase is what they call base app. That's kind of the primary area where you're trading a lot of these top 10 tokens that you think about. And as well, this derivative space, I don't like to think about options as much. Think perpetual futures. This is kind of the crypto market growing up. It's providing a lot of tools that institutional traders use, significantly more than just trading at the spot markets for these tokens. So it gives them the ability to kind of protect themselves, to gain exposure at different time periods. And I think it's really interesting. You look at just the deal closed in August. You look at just October's volume that Coinbase announced, and it was 266 billion for their derivatives platform. If you annualize that, you're at about a $3 trillion number. That's going to get you at 5 basis point fee, 1.6 billion in additional revenue kind of going forward. And that's really just about the Coinbase market share largely globally. There's really an opportunity, I think, for them to go 4, 6, maybe even 8% of the derivative space. The biggest competitor, obviously, is Binance. They own about 30% of the derivatives trading and largely the spot trading. And so it's an area where I think now Coinbase can really compete on a level footing with this industry leader as a platform for leading spot and futures trading in all of the primary crypto assets.
Yeah. Now when you talk about trading, usually what comes to mind is stablecoins, but you've talked a little bit about how that has changed, about how stablecoins have been moving to different arenas. So could you maybe elaborate on that?
Yeah, stablecoins are really an interesting space. I think they're gaining the most interest from institutional investors. So if you're not too familiar, a stablecoin by its nature is one-to-one backed by reserve assets. Historically, those have been a little more loosely defined with what they are. In fact, the largest stablecoin out there from Tether, USDT, is a $186 billion market cap. That is about 75–80% backed by US Treasuries, but it's also backed by 5–6% gold and 5–6% Bitcoin. Now, historically, that's been okay. There's been some questions about Tether's reserves, but what's really interesting is last year's Genius Act put some rules and regulations in place requiring compliant stablecoins here in the United States to be backed by one-to-one with specifically US Treasuries under 90 days. So it really positions Circle and the USDC coin, which is 75 billion, as a premier kind of player, as the first really large regulatory compliant coin. And it's a space that I think in the future and moving near term is going to compete with money market funds, which are about a $7.5 trillion industry in the US, 10 trillion globally. We see the stable coins right now at about a $300 billion market cap. So it's a really growing industry. And I think there's a lot of potential for this to move into, payment processing, transactional businesses. And, Coinbase, I think, is really positioned well with its partnership with Circle.
Yeah, so maybe discuss that a little bit more. The top two traded names in the space are Circle and Coinbase. So what should investors think of maybe the differences or similarities between those two entities?
Yeah, Circle, I wouldn't maybe say this, but it's kind of a one-trick pony right now. It's has one primary product with USDC. That's a $76 billion float on their token. They have an EURC, kind of a stable coin that's tied to the euro, that's significantly smaller, generates significantly less revenue. Around 20% of all USDC is held on Coinbase's platform. Since their partnerships, that's continued to grow. It's really only one revenue stream for Circle compared to Coinbase. You have the return that you're earning on your reserve assets, which in this case are 90-day treasuries. So think 3.5%, maybe 4% return on that $76 billion number, as opposed to Coinbase, who is an exchange. They're obviously growing into a lot of different industries. Circle is working to diversify away from kind of this one product risk, but that would be the primary differentiator.
Yeah, no, that makes sense. Another key arena is regulation. Obviously that has been a headwind for many years, but I get the impression that is changing. Is that correct? How do you view the regulatory environment right now?
It's very much changing as we speak even. I think if you go back to the end of 2024, starting with Trump's re-election or election, this is the most pro-crypto administration we've ever had. There's an executive order that's been put out recently to kind of foster the growth of US dollar compliant stablecoins. I think the administration and the SEC are treating these more like a developing asset class and something that we should look to encourage growth in as opposed to regulate away. I think changes within the SEC when Trump came in are pretty large. You look at the SEC no longer looks at crypto coins, especially smart contracts and things of that nature, and says these are securities. We need to treat these like they're stocks and regulate them as such. That really hampers the dynamic issuance and redemption of a lot of these securities and how some of the underlying blockchains work. But there are still some real problems with the regulation, and there's one big kind of glaring loophole that exists right now within the Genius Act. As I mentioned, Circle is the company that issues USDC. They're not actually allowed to pay a yield on that as the issuer, but every company's platform that has those tokens on those platforms are able to pay a reward. So what you're seeing is what is incentivizing the growth of these tokens is you buy USDC, you own it on a Coinbase account, and right now you're able to earn 3.5% yield. As you know, it's kind of like a savings account, a money market fund there, and this loophole is something that is actively being debated in Congress right now and in the Senate within the Clarity Act. The crypto-focused businesses are looking for, I would say, even footing and a level playing ground to compete against banking assets. Legacy, banks are looking to kind of protect their deposit base. And so where exactly that regulation falls, whether these yields or rewards, as they call them, are able to be paid on these stablecoins, will ultimately determine the growth of this industry long term. And I think it's probably too early to say exactly where or when that will fall. But right now, prediction markets have about a 40 to 45, 50% chance that the Clarity Act is passed this year. But that doesn't let us know whether these yields or rewards will be compliant.
Now, you just referenced prediction markets. I saw you included that in your thematic. That was a little bit of a surprise to me. Why do you think that's relevant for crypto players?
It's definitely a very small piece of kind of the business now and probably going forward. Recently, Coinbase partnered with one of the largest prediction markets and invested in their Series D, I think about $300 million. So they are believing in this space. I think it's important to know that from 24 to 25, this is an industry that went from 9 billion to 50 billion in volume, and they exited the year at about a $10 billion a month run rate. So it's really ramping up pretty quickly. I know a lot of people were really introduced to this space during the last presidential election, but this is really growing in terms of the number of contracts that people are able to mutually create and gamble or predict on, whatever you'd like to use here. Daily weather forecasts, you could bet on the Oscars. You can even go right now and there's millions of dollars trading on whether the US will acquire part of Greenland this year. It's really a kind of new frontier. It's creeping into sports betting with some of the event contracts, and we're seeing some pushback from state regulators there. But this is a space where I think Coinbase's customer base is already used to trading volatile assets. And I think there's a potential for those customers to really be, largely engaged in these platforms, whether it's specifically, political, sports betting, anything on those platforms. I think there's a natural, probably, blend of the customer base between people that are already on prediction markets and Coinbase. And so I think you could see this space continue to grow. Again, it's probably a small piece of Coinbase's overall footprint in the future, but it's one that's definitely interesting to keep an eye on.
Yeah, no, that makes sense. So it seems like your focus has mainly been Coinbase. That is the area that you're most positive on. So maybe talk about your valuation there a little bit. I believe your price target is $290 with a buy rating. So, maybe go into that valuation a little bit.
Sure. Right now it's a buy. I believe we're having it at about a 6.8 times revenue multiple on our 2026 estimate. I think, like I've said, it's a really exciting company. They're at a $7.6 billion run rate on revenue. We see the potential for the growth from Deribit and the growth in their derivative space to add 1.5, potentially 2.5 billion in revenue pretty near term within the next year and a half. The stablecoin piece, I think it's going to take a little longer, but there's really an opportunity for $2.5 to $3 billion in additional revenue from this stablecoin growth. As a lot of people are predicting it's going to hit $1.5 trillion in 3 to 5 years. I think we're probably believers in that, assuming regulation kind of falls in the way that benefits the cryptocurrency industry. And it's important to note that even after paying 75% of those reserve returns, so think your 3.7% yield on treasuries, even after paying 70% of those fees to the customers on your platform, this is still 900 to 1.2 billion in incremental pre-tax profit, and so that's really exciting. The prediction market's a much smaller piece. It's probably 40 to 60 million in revenue at a high margin rate there. And ultimately, we think that this is a platform that can go from 7.5 to 11, potentially 13, 15 billion in revenue in the next 5 years. So that's ultimately what gets us really excited. You have a big IPO pipeline. You have a company like Coinbase that I think is touching a lot of different verticals in a way that a lot of these other companies aren't. And they already have, regulatory compliance. They're seeing where the industry is moving. And I think, I look at what the CEO, Brian Armstrong, said last year. He said that they want to be the #1 financial services app in the world in 5 to 10 years. It's probably a lofty goal, but that's what they're aiming for. And he claims that, all asset classes, money market funds, stocks, bonds, real estate, debt, these are all coming on chain. They're coming and moving onto the blockchain and transacting in, these smart contracts on these platforms. I'm not sure we agree maybe with the timeline. I think it'll take a little longer, but I think this is one of the reasons you're seeing something like even NASDAQ move to 24/7 trading in the future, as they see this tokenization of these large cap stocks coming and don't want to lose out on the volume that's transacted outside of their exchanges. This is a space that's rapidly evolving. And I think the other thing to think about lastly that's exciting about Coinbase is it's a younger generation app. I think as time goes by and as these younger generations age and start to move into, prime earning years, it's kind of the customer base that's most likely to engage with all of these products that's been native to crypto over its, young years.
Great. Yeah, I mean, this conversation has been quite positive. Obviously, you're quite bullish on the space, but maybe, we wouldn't be doing our job if we didn't mention some risks. So what should be what are the key risks that we should be thinking about?
Primary one, obviously, that I touched on a little bit, regulatory uncertainty is a big one here. I would not be surprised, even if it's a maybe a lower probability scenario, to see Congress move to protect banks, especially small regional banks. They don't want to see deposit flight from these industries into maybe these digital asset spaces in the way that the crypto firms would like to see it, especially with kind of stable coins and how their yields and rewards might be higher than savings rates that you're able to earn on some of these platforms. Another risk that obviously remains volatility. If you've been in the crypto space for any number of time or any length of time, that 70% drawdowns are just kind of normal. There's not a lot of asset classes or spaces where if you live in them for 10 years, that's a normal thing. And despite Coinbase being more diversified, having some stable subscription revenue within their business, it is correlated to these underlying assets, primarily Bitcoin and Ethereum, and the directions that they move. So it does make it difficult in a down market for those two major cryptos tokens to see strong outperformance. But I do believe it's slowly kind of breaking away from underlying price correlation as the business matures. Another one, just in terms of Circle, it's long been much smaller than Tether and USDT. Tether is launching a US compliant stablecoin separately. That is an area where they need to either gain or grow share as the space grows, because they're obviously only the second largest player. The other elephant in the room as this goes institutional is traditional financial institutions could enter these spaces. There's groups like CBOE, CME Group that have been running exchanges for many years. When they see the volume that you're trading on crypto exchanges, they might become attractive markets now that the Genius Act has been passed. There's some regulatory support for these industries. It might finally be a green light to go set up their own exchanges and to try and capture some share here. We do think Coin is ahead of a lot of their peers in terms of the regulatory space, but for banks and groups that have been around for a lot longer, they could be on the back foot a little bit if they decide to kind of aggressively come in and spend in these markets to try and capture share.
Yeah. Great. Let's wrap there. Thank you, Nathan, for sharing your expertise on crypto institutional adoption. And for more insights, we recommend checking out cfrresearch.com. Thank you.